This is Nightly Business Report.
Gains fizzle. Stocks soared out of the gate this morning, first day of trading of 2015, but it didn't last. And by the closing bell, the S&P 500 did something it hasn't done since 2008. Direct response. President Obama authorizes additional sanctions against North Korea in retaliation for the cyber attacks against Sony Pictures. And in the spotlight, 5 CEOs who have their work cut out for them in 2015. All that and more tonight on Nightly Business Report for this Friday, January the 2nd. And I wish you a good evening, everybody. Happy New Year. I'm Bill Griffith, in tonight for Tyler Matheson. Well, after a strong 2014 for stocks, the new year on Wall Street began with a whimper today as the major averages ended the first trading day of the year mixed and little changed. After an early rally was wiped out by data showing a slowdown in manufacturing and construction. Here's how things looked at the first closing bell of the year, with the Dow up triple digits on the open this morning, but it ended up about 10 points higher when all was said and done. The Nasdaq down by 9 points and the S&P lower by a fraction of a point, making this the first time since 2008 that the S&P 500 fell on both the first day of the new year and the last day of the prior year. Meanwhile, oil prices continue to slide lower. Domestic crude fell another 58 cents to close at $52.69 a barrel. Brent North Sea in London was down 91 cents a barrel, closing at $56.42. By the way, the U.S. dollar index was nearly a full percentage point higher today. That is now at an 11-year high, 11 and a half years to be exact. More now on today's disappointing economic data, which showed that the U.S. manufacturing sector pulled back last month to the slowest pace in 6 months, while construction spending dipped in November on fewer new projects from the federal government. And that pushed the yield on the benchmark 10-year Treasury note lower. It fell back to 2.1% today. But strong economic data was a big part of the solid gains we saw in the markets in 2014. The big question now is, for the new year, will the economy and the markets continue to grow? Steve Leisman takes a look tonight.
2015 should be the year we find the missing link in America's 5-year-old economic recovery. We've had a surging stock market, runaway corporate profits, and in the second and third quarters of 2014, the best 6 months of growth in 11 years. But what's been painfully absent has been improving fortunes for average Americans, and many economists think that could change in 2015.
The wages are going up 2%. I think next year they go up more like 2.5%, heading up to 3% in 2016.
Add to that plunging gasoline prices and a 30% decline in natural gas costs, and consumers should have more money in their pockets this year, filling in that missing ingredient of the recovery. And there could be more firsts this year.
I think sometime around the middle of this year, the Federal Reserve will start raising rates. But even more important than that, I think the pace is going to be pretty gradual.
It would be the first rate hike since 2006, and forecasts call for gradual hikes by the central bank. One reason rates fell last year was weakness in foreign economies, especially Europe and Asia. So far, the U.S. recovery has weathered that weakness, but it remains the major threat for 2015. Another is that lower oil prices drag down the U.S. economy because the nation has become such a significant producer in the past several years. But most economists still see it as a net positive for the U.S. And it appears that U.S. exporters will be challenged by a stronger dollar, which makes their goods more expensive overseas. But the fundamentals do appear to line up for a modestly upbeat year of growth of around 3%, a year when average Americans should enjoy more of the fruits of the expansion than they have so far. For Nightly Business Report, I'm Steve Leisman.
Our next guest says there are reasons to be optimistic about the economy in 2015 and for the stock market, though it could get rocky at times. Jeff Sott is the Chief Investment Strategist at Raymond James. Happy New Year, Jeff.
Merry New Year, Bill.
Thank you very much. You know, we've had 6 consecutive years of gains for the U.S. stock market. The best year, we were up 26%. The worst of those years, we were up 5%. Where do you see us falling in 2015?
I think you're going to start the year off on the downside here. The timing models that predicted last year pretty darn well are calling for some rockiness in January and into February. But overall, I'll stick with the same forecast I gave at this time last year for 2014. I think the S&P will be up somewhere between 10 and 12% for the year.
And what will drive that? I mean, this is a period of time where we know oil prices are already low. They're expected to go higher. Interest rates are low. They're expected to go higher. Will that put a crimp on, or a cap, if you will, on the economic data, or will it help it?
I think it'll help it. I think Janet Yellen got it right. I think the economy has reached escape velocity. Normally, at this stage of an economic recovery or a business cycle or an expansion era, you tend to get a mid-cycle slowdown. What is interesting about this is the economy appears to be accelerating when normally you would get some kind of slowdown. So I'm pretty optimistic on the economy and the American consumer.
Job growth is better than it has been. We had a very good number the last couple of months. Wage growth, we're still waiting on. It's starting to show signs of gaining, but you think we will see an acceleration there. Why?
I do, because I think the economist that Steve Leisman interviewed had it right. You're getting a tightening in the workforce in terms of the slack in the workforce. You did see wages pick up modestly this year. We think that's going to accelerate next year to what the economist was talking about, maybe 2.5% to 3% going into 2016. The drop in the price of gasoline, according to Ed Hyman, is the tantamount to putting $200 billion in increased purchasing power in the hands of American consumers, especially impactful at the lower end of the wage scale. So the American consumer looks in better shape than they have in a number of years.
Well, let's make this meaningful to investors. What sectors, you're the investment strategist, where would you put money to work in 2015?
I've seen this act before. I think we're in a secular bull market. We're almost 6 years into it. They tend to last about 15 years, so I think you've got another 8 to 10 years left in this one. And at this stage of the market cycle, you're at the stage where I think just about everything works.
I mean, this past year, utilities were the best performing sector. Healthcare not far behind it. Energy, the worst performing sector. So where are you going to continue those trends, do you see, or would you put new money to work someplace else?
Well, I think you're going to get a pickup in the capital expenditure cycle. Companies have been shy on spending money on CapEx. There's a lot of equipment that needs to be replaced. I think technology benefits by that, so I would overweight technology. And after the performance utilities have put in last year, I would underweight utilities.
What about energy?
I think energy's a buy. We talked about this with Saudi Arabia playing the trump card and pressuring oil prices for a lot of reasons, but particularly for political reasons. And we think it's temporary. My energy team, which I think is one of the best in the country, is looking for a bottoming in the energy cycle. And energy stocks just look plain cheap. And my daddy used to tell me good things happen to cheap stocks.
Jeff Sott of Raymond James, always good to see you. Happy New Year. Good weekend.
Right back at you.
Thanks very much. Well, after recalling 84 million vehicles in 2014, General Motors kicked off this new year with, what else? Another recall. This time, it's for nearly 90,000 pickups and SUVs dating back to the model year 2007, all to replace a faulty ignition part. You wonder when it's going to end. For companies like General Motors and its embattled CEO, every new year brings the promise of change, as well as a whole host of new challenges. Well, this year, a number of high-profile CEOs are making big changes to their companies, changes that they hope will keep them squarely in the investor spotlight. Mary Thompson has more.
The party's over. Now it's back to work. And for some CEOs like Twitter's Dick Costolo, they'll need to work fast.
He's unpopular right now, for sure, and I'm sure that there's an element of pressure. But if they execute through the year, then I think it'll be status quo in terms of management.
Costolo, one of several big-name CEOs who need to recharge their companies. Twitter's stock fell over 40% last year, given Costolo's struggles to define the microblogger's mission and hold on to key managers. His strategy for the new year: strengthen Twitter's core audience, make the service easier to use, and gin up new services to attract new users. McDonald's unveils a new menu this month, part of CEO Don Thompson's plan to revive the fast food giant's sales in the U.S. With monthly sales a key barometer, it won't take long to know if this is the right recipe for a turnaround. Yahoo stock is up over 120% in the past 2 years, but critics claim that has more to do with the company's multi-billion-dollar stake in the Chinese internet giant Alibaba than it does with CEO Marissa Mayer's leadership.
I think the problem here is she just has too much money and she has to spend some. Investors are going to get fed up and they're going to say, just give us the cash.
Mayer plans to give half of the proceeds from the Alibaba stake to shareholders. The question is, what does she do with the rest of the money? After a flattish year for sales and a weak one for profits, Coke plans to cut costs and shed its low-margin bottling business. Analysts wonder, though, is CEO Muhtar Kent's plan enough? And can he execute it fast enough to keep disgruntled investors at bay? With IBM the worst-performing Dow stock for the past 2 years, CEO Ginny Rometty needs to reverse that trend.
I think Rometty has been dealt a very difficult hand. She basically inherited a strategy that had been enunciated by her predecessors of getting the company to a $20 EPS number.
She did abandon that forecast, embracing her own strategy to reinvigorate the tech giant with a focus on cloud computing, mobility, and security for corporate clients. A plan expected to put the past year's woes behind IBM, so its stock rings up gains in the new year. For Nightly Business Report, I'm Mary Thompson.
Still ahead, Intel started 2015 right where it left off in 2014. That would be higher. And with shares soaring nearly 40% over the past year, can they keep moving higher? Well, it probably won't take long for the new Republican-controlled Senate to push for legislation to complete the controversial Keystone XL pipeline. Next week, when the new Congress comes into session, a Senate committee is scheduled to vote on legislation approving that pipeline. The vote will then pave the way for the bill to come up on the entire Senate floor. It's been a long time coming. Also in Washington, the White House today announced new sanctions against North Korea, citing the hack attack against Sony Pictures as the reason. John Harwood joins us tonight from Washington with more. And John, what are these new sanctions and who specifically are the targets?
Well, Bill, there were two executive orders that President Obama signed, one targeting the government of North Korea, the other targeting the main political party there. Also, 3 distinct entities were sanctioned under those 2 orders and 10 individuals. And the challenge is that most of these people or organizations are already severely affected by the sanctions that have been in place for many years. The question is whether or not the United States government might be able, by sanctioning them specifically and those 10 people by name, convince other countries not to do business with some of those people. Of
course, with any economic sanctions against a foreign entity, the question always comes up, will they have any real impact? What do you think?
Not a whole lot. The North Korean economy is pretty small. Their economic relations with the world are small. It's kind of like what happened when the internet was shut down in North Korea. Only 1,000 IP addresses in the entire country, so there's only so much you can do. But the administration is hoping to make a point to the rest of the world and also have some modest impact.
Let's talk for a moment about the new Republican majority in both the House and the Senate. Do we expect the White House and Congress to get any significant business done together this year, or is that still a pipe dream?
I think there are some things that can get done, Bill. First of all, if you simply fund the government, avoid having a government shutdown, avoid having a debt limit crisis, then you've taken a step ahead of what Congress has done over the last few years, because those things were damaging to the economy, damaging to the markets, and they created uncertainty in the business community. So that's one thing, smooth waters on the budget. Second are things like trade deals. There's the Trans-Pacific Partnership, where the administration is actively negotiating, hopes to finish sometime in the middle of this year and get passed through the Congress this year. Republican leaders support it. The White House supports it. That augurs pretty well for the possibility to get that through.
There's always hope. John Harwood in Washington, thank you. Have a good weekend.
You too.
Back to Wall Street now, and a closer look at tech giant Intel, which was, as it turned out, the darling of the Dow in 2014. Shares of the company shot up by more than 40% last year and closed slightly higher today as well. The question now, Can that kind of run continue in 2015? Josh Lipton has more.
A bet on Intel is a bet on the PC, and for those investors who wagered correctly, they enjoyed big gains in 2014. The PC market last year didn't crash and burn as many expected. Instead, it was basically flat, which was good news for Intel. The company dominates the market for PC chips, which accounts for 60% of its sales. One tailwind for the PC market in 2014, Microsoft ending support for its Windows XP operating system. That prompted companies to buy new computers.
The fact that Microsoft was basically removing support for Windows XP, which was basically powering about almost 50% of the installed PC base, basically set in motion a very large and significant upgrade for Intel, which any investor following the tech sector, as soon as Microsoft made that announcement, would have basically run out and bought Intel.
The question now is how much of a tailwind that will be this year. For its part, Intel expects PC units to be flat and revenues slightly down in 2015. The other big part of Intel's business is providing chips for servers, which accounts for about 20% of its sales. The company says revenue in that business can grow at a 15% rate at least through 2018. There are challenges for Intel, however. The company's mobile business is expected to keep losing money next year. But CEO Brian Krzanich, who took over in May 2013, says he's committed to turning a profit in this business. We are in this business not to lose money, but to make money in the long run, he said at the company's investor meeting in November. No surprise, after such a strong run, some on Wall Street also worry about the stock's valuation. The team at RBC says Intel stock now looks pricey. Still, bulls are in charge when it comes to Intel, at least right now, betting on a stable PC market, growth in the data center market, and the company's ongoing commitment to capital return. For Nightly Business Report, I'm Josh Lipton in Silicon Valley.
Linn Energy cut its investor payout and its budget, and that's where we begin tonight's market focus. Linn is the latest energy-related company to announce a cut in its capital spending plan because of the recent drop in oil prices. On top of that, the oil and natural gas company slashed its dividend to $1.25. The payout used to be closer to $3. Still, shares rose today, up 12% to $11.35. Rite Aid saw its same-store sales jump by more than 5% last month. That topped estimates with help from strong pharmacy sales. The improving sales figure comes even as cheaper generic drugs weighed on the drugstore chain. Shares were up nearly 1.5% to close at $7.63. And shares of MiMedx plunged after the medical products maker said that it received a subpoena and that U.S. regulators are investigating its sales and marketing practices. Also, the company sued one of its competitors over claims of business interference. The stock today tumbling by 15.5% to close at $9.74. And shares of Bed Bath & Beyond rose on an upgrade today. Canaccord Genuity now rates that stock a buy, since the firm believes that the retailer had a strong holiday shopping season, and it expects that momentum to continue into early 2015. Bed Bath & Beyond up 56 cents to $76.73. All week, we've had Market Monitor guests giving you stock picks for 2015, and we continue that tonight with our friend Richard Steinberg, who says we are in a show-me environment right now. He's president of Steinberg Global Asset Management. Rich, Happy New Year. Always good to see you.
You too, Bill. Good to see you.
I mentioned we've had 6 consecutive gains in the market annualized. You're a big value player. Do you still see good value in this market right now?
Listen, I want to go into this year more bullish than I currently am, Bill. Earnings have come down just from like December 4th or 5th from 130 in the S&P down to 126. We're still at 130, but when you apply a 16 multiple, you get to 2,100. We're hearing these 8 and 10% return numbers, but it's going to take a big show me in earnings increases and potentially a multiple expansion. When interest rates go up, oftentimes you get a little bit of lift in multiples, but I think it's going to really depend on what happens with earnings calls early in this quarter.
I mean, you sound like somebody who's going to have to be more selective to find value. You're going to have to take this almost on a stock-by-stock basis, aren't you?
Yes, and also even in the ETF space, investors have to be very target-oriented. If they own something, they better know where full valuation is. They can cut it back, but we're going to be in a volatile period, Bill, and you're going to have opportunities to pick up cheap names. So even though the market may kind of run in place for a little bit, there'll be fits and starts to make money.
Let's talk about stocks where you do find value right now. Macy's in the retail sector.
So Macy's is trading at 13 times earnings. We have a $75 target. Thesis that you and I have talked about before is we do think that the consumer, especially at the low to mid end, is going to get a boost from energy prices. And you have great management, and you have weak competitors in JCPenney and Sears.
Gilead Sciences in a sector that's been very volatile. It typically is, but why do you like this one? I guess you think it's still valuable.
Well, this name got busted up a little bit because AbbVie, which we also own, did a deal with Express Scripts to be the top Hep C drug for Express Scripts in terms of being reimbursed. So investors sold off Gilead. The stock's trading very cheaply at under 10 times earnings. In the next 4 years, they'll throw off close to $50 billion in cash flow. Even if they use $25 billion of that to reinvest in their pipeline, we think it's really cheap and a really solid name with a $120 target.
Okay, and then everybody's watching energy. Those of us consumers enjoy the decline in energy prices. Is it time to buy energy stocks? You like Devon Energy in that sector. Why?
This is in our growth portfolio. They're 80% hedged next year with West Texas over $90. The stock is trading at 1.1 times book, and we think that it's probably a more conservative way, if money comes back into energy, to buy the stock. We have a $75 target. All three of these stocks are in our growth portfolio. I don't own them personally, but they're in our firm's growth portfolio.
I know there are always things that keep you up nights. Let me ask you one about that a lot of investors want to know about the Federal Reserve and when they start raising rates and what you think the market's response will be to that.
Well, let's talk about what's happened to the 10-year, right? The 10-year is down to, sub 2.25% right now. So the bond market is actually giving us a little bit of cushion when the Fed starts to increase. I think they're going to be very methodical in their increases as a quarter of a point at a time. Don't forget, if you have a strong dollar and a weak euro, and you have QE going on in Europe, it's going to be very hard for the Fed to increase rates too much too quickly because it'll become anti-competitive for U.S. companies selling abroad and could hurt job growth. And we know that people are focusing on job growth in the markets and in Washington.
That is for sure. Richard Steinberg of Steinberg Global Asset Management. Thanks, Rich. Have a good weekend.
Take care. Bye-bye, Bill.
See you later. Coming up, the new year is ushering in some new laws, including one that could push the price of eggs much higher. Uncle Sam's approval for new medications hit an 18-year high in 2014. The FDA gave it the okay to 41 new drugs last year, including 15 medicines for so-called orphan diseases, rare disorders that affect fewer than 200,000 people here in the United States. Well, a new year also brings a whole new list of laws and regulations, and Jane Wells tonight has some of the more notable and even the more bizarre laws now in effect for 2015.
From California, where illegal residents can now apply for driver's licenses, to New York, where you now have to recycle old tech gadgets, new laws reflect a changing America. From a worker perspective, about 20 states are raising their minimum wage, the highest being Washington State, which is closing in on $9.50, though in Seattle it's already $15. And in Illinois, employers can no longer ask about a criminal history on initial job applications. From a business perspective, in Massachusetts, out-of-state wineries can now ship wine directly to consumers there, potentially lowering prices. And in healthcare, Arizona will allow residents to try medical treatments which have gone through clinical trials but are not yet FDA approved. And then there's California.
Over 900 new laws are taking effect in the Golden State. Where do you start? Mandatory breast pumping stations at California airports. mandatory sick leave for employees after they've worked the first 30 days. And on college campuses receiving state aid, students have to clearly consent to sex. No means no isn't enough. Being drunk isn't consent. And the burden of proof switches to the accused. But wait, there's more.
All eggs sold in California must now come from chickens, which have about a square foot of space per bird, twice the traditional average. Even egg producers outside of California sending eggs here have to abide by the new rules. One report suggests that could send egg prices up as much as 40%. Also in California, restaurants which want to allow dogs now can if they follow certain rules. But of all the new laws about animals, none is more amazing than the one in New York, banning so-called tiger selfies, photos of people dangerously close to big cats. Sounds like it's still legal to sit next to the tiger, just don't take a picture of it. But then what's the point? For Nightly Business Report, I'm Jane Wells.
And finally tonight, the new year also means resolutions, of course. There's the usual commitments to lose weight, get in shape. We spoke with some people about what their financial resolutions are for the new year.
Creating a budget. Sticking to it, yeah.
We're trying to get rid of our student loans. Save a little bit more, put a little bit more into the retirement plan.
Not overdraft my bank balance. I have a bank account and I'm going to try to put money in it, not take it out.
Save up some more so I can retire and do some more travel.
Watching what we spend, not going out to eat, not going to the movies, just really all the luxuries we're going to try to cut back on this year.
Contributing more to an IRA.
Probably bring lunches to work.
Writing down a goal, because if you don't write it down, it's not real.
Well, let's hope we can all commit to some of those promises for 2015. That is the Nightly Business Report for tonight. I'm Bill Griffith. Thanks so much for watching, everybody. We'll see you again on Monday. I'm Bill Griffith with the Nightly Business Report News Brief. Wall Street kicked off a new year of trading with the major averages ending mixed and little changed after data showed U.S. manufacturing pulled back last month to the slowest pace in half a year, while construction spending dipped in November on fewer new projects from the federal government. At the close, the Dow was about 10 points higher, the Nasdaq was down by 9, the S&P 500 lower by a fraction of a point, and oil prices continued to slide lower. The White House announced new economic sanctions against North Korea, citing the hack attack against Sony Pictures as the reason. And a new year, a new recall for General Motors for nearly 90,000 pickups and SUVs to replace a faulty ignition part. Tune in to Nightly Business Report here on public television stations around the country.